You mentioned Bitcoin. The last time we talked, I think, was towards the beginning of 2022. And you rightfully said, hey, I think Bitcoin's going to crash. You were smart enough not to put an exact price target or a timeline on it, but you were like, sometime this year, I think there would be like a correction. Talk a little bit now in hindsight, after having said that, kind of this year and how it's transpired, how much of it fit within what you thought was going to happen versus you got the intended outcome, but maybe some of the details were different.
Good question. So, in the economy, obviously, the way that I look at it anyway is that housing and transportation can often be leading indicators of the economy. And so what I was seeing when I was here with you earlier this year, was I was seeing some of the deterioration in housing, right? Because it's a leading indicator. And so then what you saw also from my perspective was you saw deterioration in lumber pricing. And so you started to see some of these commodities that had gotten so big so fast, in terms of price. And so I said, it's only a matter of time before, the drain in liquidity coupled with this commodity disinflation affects Bitcoin. And so that's why I had said that.
What are your thoughts about Bitcoin now? Price has gone down 75%. I think you're still holding Bitcoin. You like Bitcoin. Is that all true?
Yes, and I'm going to wait to be buying a little bit more. I think that it's still a little too expensive given the liquidity dynamic. I think we're going to have continued liquidity problems in the market, in my opinion, first quarter next year.
And is that all being driven by the Fed just tightening financial conditions,
Yes.
keep raising interest rates and selling off assets?
Again, you're talking to a housing guy, so I have kind of a unique perspective from an interest rate standpoint. We say in housing that interest rates are the mother's milk of housing. And so when you cut off the mother's milk of housing, in my opinion, that also goes downstream into the economy. And so I think that these interest rates, the effects of these interest rates has not really been felt. It's been felt in housing, but I don't think it's made itself to mainstream business.
And as you think about those interest rates, we've seen all year long they've continued to increase. We've seen the sell-off of asset prices, and they've stated, we want to destroy demand. We want to destroy demand. They've done a fantastic job on the investment appetite side. There is very little appetite for investment at the moment. On the other side, though, you have consumer spending, you have household income, you have savings, like all these other metrics that seem to still be like fairly healthy. How do you balance destruction of investment assets and investment prices with what still seems to be a somewhat strong consumer?
I think it's only a matter of time. And I think, we're in the HVAC business. That's where I spend a lot of my time direct to the homeowner. And we are seeing people being really reticent, so to speak, to spend the big ticket items that they were doing a year or two ago. So I think it's going to be a lag effect, and it's just a matter of time.
Yeah. And that means that the Fed at some point will have to pivot. And
I think they already have. I mean, they went down to 50 basis points. And, I think they'll continue to increase, but it could be potentially pretty tough.
4.5% now. What do you think they get to?
Don't know, but I'll tell you this.
6?
I don't know, but I'll tell you this. These mortgage rates are not very good. I mean, these are not very good things for the housing market. And so I think it's going to be good for the housing market as a buyer, as a consumer. I think it's going to help a lot of people. But the zoning in our country has made it, in my opinion, to where in addition to people not being able to build enough because of the last recession, people don't want to build a lot of these big subdivisions anymore. And so I think that's also going to keep housing prices pretty high.
When you evaluate the mortgage market, we've seen an explosion. I know people who are getting, 2.2, 2.5% mortgages a year ago. Now all of a sudden they're looking at 5 or 6%. Is it literally just number goes up, demand goes down, or is there more complexity to it?
No, it's literally as simple as that. I mean, obviously you have the wage issue as well, but you have basically, if you dumb it down, you have interest rates and you have wages, and wages have stayed pretty strong, whether that's through inflation or through the inertia in the economy. But you have this interest rate situation, and it definitely, what it does is it initially affects traffic, and then once you see it in traffic, you see it in orders, and then once you see it in orders, you start seeing it in cancellations of homes. And you've seen cancellations go from, in some of these cases, 12, 13% of orders to 25% of orders. I mean, that's a huge increase, in cancellations. People, signing a purchase agreement and then canceling it later. That's not good. A quarter of the homes being canceled.